What if I told you there is a strategy, simple, proven, and completely legal, that has quietly turned ordinary working people into millionaires? Not through day trading, not through crypto, not through luck, through something most investors ignore. This is the story of dividends. And by the end of this video, you will never look at the stock market the same way again. Here is a fact that should alarm every working American. The average household has less than $40,000 saved for retirement. Meanwhile, most financial experts agree you need at least $1 million to retire comfortably. That gap between what most people have and what they need is enormous. And the reason most people never close it comes down to one fundamental mistake. They save money, but they do not put it to work. A savings account paying 1% interest on $40,000 earns you just $400 a year. After inflation, you are actually losing purchasing power. This is the savings trap, the illusion that setting money aside is the same as building wealth. It is not. Real wealth is built when your money earns money, and that money earns even more money. The tool that makes this possible has existed for over a century. It is called a dividend. So what exactly is a dividend? When you buy a share of stock in a company, you become a partial owner. And just like any business owner, you are entitled to a share of the profits. Dividends are those profit payments, typically paid every quarter, directly to shareholders. Think of it this way. If you own shares in a company that pays a 3% annual dividend and you invest $10,000, you receive $300 in cash every single year, just for holding the stock. But here is where most people stop thinking and why they miss the real opportunity. $300 a year sounds modest, almost not worth mentioning. But what happens when you do not spend that $300? When instead you buy more shares? That is where the real story begins. This concept has a name: DRIP, Dividend Reinvestment Plan. It is as simple as it sounds. Instead of taking your dividend payment as cash, you automatically reinvest it to purchase additional shares of the same stock. No broker fees, no timing the market, no decisions required. Your dividends buy more shares. Those shares generate more dividends. Those dividends buy even more shares. This is the mechanism behind what Albert Einstein reportedly called the eighth wonder of the world: compound interest. And here is why DRIP is so powerful. In the first year of investing, the effect is subtle. You earn a little extra. But 10 years in, your dividend income has grown meaningfully. 20 years in, the snowball has built real momentum. 30 years in, the results look almost impossible. Warren Buffett, the most successful investor in history, has earned over 90% of his wealth after his 50th birthday. Not because he worked harder in his later years, but because his compounding snowball had 30 years of momentum behind it. The dividends from Berkshire Hathaway's portfolio now generate billions of dollars annually. Not from new investments, from the relentless, patient reinvestment of existing ones. Let me show you the numbers most financial advisors never put in front of you. Imagine you invest $500 per month, that is $6,000 a year, into a diversified dividend ETF with an average yield of 3% and average total return of 9% annually. After 10 years, your portfolio is worth approximately $100,000. Respectable. After 20 years? About $340,000. The snowball is gaining speed. After 30 years, your portfolio crosses $1,200,000. From $500 a month. The total you contributed was just $180,000. The other $1 million was built entirely by compound returns and reinvested dividends. This is not theory. This is arithmetic. The S&P 500 has paid dividends every single year since 1926. Through wars, recessions, crashes, and pandemics. Companies like Johnson & Johnson, Coca-Cola, and Procter & Gamble have raised their dividends for over 50 consecutive years. They are called dividend aristocrats, and they are the engine of this strategy. So how do you actually build a dividend portfolio? The simplest path for most investors starts with two options. First, a dividend ETF. Funds like VYM, SCHD, or DVY hold dozens of top dividend-paying companies in a single purchase. Instant diversification. Automatic dividend reinvestment. Low fees. This is where most people should begin. Second, individual dividend stocks. Look for companies with a dividend yield between 2 and 5%, high enough to matter, but not so high that it signals distress. Look for payout ratios under 60%, meaning the company is not overextending to fund the dividend. And look for at least 10 years of consecutive dividend growth. The account type matters too. A Roth IRA lets your dividends grow completely tax-free. After age 59 and a half, every dollar is yours. No taxes owed on decades of compounded growth. If you are starting with limited capital, begin with a dividend ETF inside a Roth IRA. Automate your contributions. Turn on DRIP. And then, this is the hardest part, do nothing. Time does the work. Before you go, 3 critical mistakes that destroy dividend investing returns. Number 1, chasing yield. A 10% dividend yield sounds incredible. It is usually a warning sign. When a company's stock price has fallen dramatically, the yield appears high, but the underlying business may be in serious trouble. High yield without solid fundamentals is a trap. Number 2, ignoring total return. A stock that pays 4% dividends but loses 5% in value per year is losing you money. Always evaluate the combination of dividend income and share price appreciation. Number 3, selling during downturns. The investors who panic and sell during market crashes lock in losses and miss the recovery. Every major crash in stock market history has been followed by a recovery. The investors who stayed in and kept reinvesting dividends during the dip came out dramatically ahead. The dividend snowball does not require genius or luck. It requires a plan, patience, and time. The best day to start was 20 years ago. The second best day is today. If this video gave you value, subscribe to Market Mapped for more in-depth lessons on building real wealth. The snowball is waiting. Start rolling it.